Hey, welcome back to our BYOB Square podcast show, where we talk about becoming your own banker and we bring a drink and celebrate our local business community. Today, we're going to be talking about a very important subject, which I'm really excited about because it was one of the ideas that certainly influenced me on becoming obsessed about this subject and really looking into it for my family and my business. So today, we're going to be talking about how banks work, how do they make money, and where does that money go for them to become more profitable every single year. So we're going to be talking about that. My name is David.
And I'm Josh.
And we're going to have just a conversation, some questions, and we're going to share our best thinking with you in hopes that it serves you and advances your understanding of how money actually works. So for today, as always, we have a business that we just feature. And the reason we do this again is because we like to support our local community and the community in the United States. Business owners represent a significant portion of the economy, and they represent a significant portion of the well-being of our community. So we like to highlight when we interface with businesses that are serving us properly, and we want to share with you. So today we're going to share Lee Insurance Solutions.
Yes, owned by Andrew and Ammon Lee, two brothers that are natives here in Arizona. They work together with this company doing property, casualty, commercial insurance, and they are fantastic to work with. I've got multiple properties with them, vehicles, travel trailer, that kind of stuff. And yes, they can write insurance just like any other insurance agent out there, but what I found fantastic was the explanation behind the recommended coverages, as well as checking in with me prior to a renewal. My old insurance agent would just let it go, would just renew the same policy, wasn't making adjustments, and where that could be critical is, especially with real estate, is as values increase, if you're not increasing that replacement cost coverage, then you could definitely be potentially underwater should your house catch fire and burn down. So that's something I greatly appreciated with them, was that upfront, open conversation of, we need to revisit these values every year. Asking me what's changed in my life, if I've acquired any other businesses, things like that, to where additional coverage could come into play. So just two great guys that have been a blessing to me in order to keep my stuff protected, and I definitely recommend giving them a call. Yeah.
In my real estate education, they always talk about, hey, build your team. In the next 10 years, you should have a team that helps you execute your strategy. And I just explained this to a client in the following way. You can have any tax professional, any CPA, file taxes for you. Get the data, put it in a format that the government can absorb, and then file that for you. But the CPAs, the strategist that can actually create something catered for your life and that continually follow up on that, are the specialists. And those are the people you want in your team. So I personally, full disclosure, also work with these folks. They have all my vehicles, all my properties insured, and on top of that, they help me create a strategy, create an umbrella policy to protect myself beyond what I can see, because they understand with all their clients that there's risks out there that maybe I don't see that they need to protect against. So highly recommended. If you want to reach their website, their phone number, their contact will be in the show notes. So give them a call and get a quote and try to understand whether for you personally or your business, you could be better protected moving forward. So
absolutely.
Perfect. The next thing we're going to talk about is a little recap in the idea we talked about in episode 2, because I thought it was really important and it's going to connect with what we're going to talk about today.
Right. Yeah, we talked about what the ideal asset is and looked at these 16 different items here to understand the pros and cons of each, different typical places that people are putting money, whether they consider it saving, investing, or speculating. And we just try to analyze what is the best thing for us, you, depending on your season of life, that kind of thing, and what you're really looking for as far as either a savings vehicle or an asset class.
Yeah. I summarize it this way. The internet is full of advice of this is bad, this is wrong, this is good, this is great. And none of those things really matter because they're subjective to somewhat situation, knowledge, expertise, right? Two people buying a stock don't have the same risk profile, the same duration of time, the same understanding of how it works. So when you look at what you're trying to do, whether it's saving, speculating, or investing, like Josh was saying, you need to understand what it looks like also for you and what asset class will serve you the best. So these are some of the criteria we use to walk through a couple of those examples to help you think through what you're trying to accomplish next.
Right. And ultimately, just increase your financial IQ.
Yeah, absolutely.
Great.
That's always the goal.
So, David, what are we talking about today?
Well, I love this subject. This is a great rabbit hole. And I think it's really interesting because it gives you insight into what is happening, how money works, and identifying a pretty critical example of success, which is banks. Banks are an incredible set of institutions at creating more money using money, usually when it's not their own.
Right.
So today we're going to talk about how banks work. Like always, we're going to keep things very general. We're going to give you examples on broad concepts. We're not going to go in depth into anything specific because what we want is to transmit an idea, pose a question in your mind so you start thinking. If you want to dig deeper, you have to do your own research. You can reach to us if you're looking for more resource to try to understand this more in depth. The government has a significant amount of data with regulators that you can go and look at. I would highly suggest looking at the FDIC website. It is going to be fascinating, shocking, and scary at the same time, but it's a fun journey to take to understand how things. So in terms of how the first question works, how do banks make money? We are going to talk about three main ideas here that we see how they make money. But I wanted to first create some context on this. So in our intro presentations, we usually talk about banks being the example to follow. And the reason is because intuitively, when you interface in society, there's three things you can observe easily. Number one, most people that you know around you don't even think about the fact that when money comes in in the form of income, that money for a fact automatically will go to a bank, regardless of what you do with the money. So banks are the largest recipients of deposits in the economy for most income from families and business owners. Number two, the other example that I like to contextualize is when you go to any city, who owns the best corner buildings or the best real estates in any given city? Chicago, New York, Los Angeles, any part of the country.
Right.
Who
Who's
would
got
own
the
those?
tallest skyscraper?
Banks. So how did they come in the last, 200 years, whatever it is, to come to own the best real estate in every city in the United States and probably the world? It's fascinating to ask yourself that.
Absolutely.
And then the third part of it is, who controls the money supply? And a lot of people will tell me the government. And I would ask you to please go and take a look at how money is created in America, because it will be fascinating to understand why banks control the money supply. So those three things are fascinating to me. But specific to the question, let's talk about how do banks make money, Josh? So
banks, they're making money by always moving money. So if money is sitting still, it's not making any more money.
Yeah.
So banks are always trying to receive deposits and then lend out that money at a higher interest rate than what they're paying us. And so what that interest ultimately is arbitrage, because we're giving them our money and then they're going out and re-lending that same money and can even lend multiple times the amount that we give them through fractional reserve banking, and they're able to make a higher rate of interest on that.
Absolutely. So motion of money, velocity of money is their primary mechanism to making money with money, which should pose the question, are you perhaps taking advantage of the opportunity of doing the same with your own capital? And if not, again, the question that we always ask is, should you be taking more control of the banking function in your life versus allowing the banks to take advantage of that? You mentioned taking on deposits and then paying an interest on deposits. This is an important distinction. I always remind everyone, if you have a checking or savings account, the reason why banks will pay you very low but still pay you interest is because technically it's a loan.
Right.
So when you are taking your savings and putting them in a bank for the convenience of having an ATM or having access or the idea that it's safe, remember, you're still lending money to the banks. Therefore, they'll pay you interest.
Right.
But that makes you an unsecured creditor of the banks. The banks will take that money and then go and issue a credit card that you pay 20-25%. And that difference is the arbitrage they're making in money they receive in deposits versus money they lend out to borrowers.
Right. Yeah. When you log into your bank account and you see that number, that's the IOU.
Yes.
It's the bank saying, I owe you $15,000.
Yes.
And because that's a loan, they're able to go use those funds however they wish.
Yes, absolutely. And look at a balance sheet of a bank. The deposits, interestingly enough, are liabilities of the bank.
Right.
They owe that money to the depositors. The loans they issue to other people at higher interest rates are their assets.
Correct.
This is so counterintuitive on how we run our financial statements in our family. Our savings in a bank would be called assets. And then when we take those credit cards, we will call those liabilities. Who's in control of the banking function in that equation?
Right.
There's a third point here that you mentioned, but I'll let you restate it.
Right. So money ultimately comes from the Fed. It's not issued by the president, by Congress, anything like that. The Fed is a third party that is the one that prints the money and ultimately acts as the big bank of all of America. And so what they do is they'll print the money and then they will lend it to Chase, Wells Fargo, Bank of America, et cetera, credit unions. So they get that money at a specific interest rate and then we'll re-lend that money at a higher rate.
Yeah.
And we can't just go straight to the Fed and try to get that money. It's a higher tier that we don't have access to as a normal consumer. You have to have a bank charter in order to be listed as a recipient of the Fed. And so, the banks will get this money, re-lend it out, make interest on that, pay the Fed back, their set interest rate. But that's why, you've got the base rate that's forever changing right now as far as what that interest rate is.
Yes. And let me make a couple of points on distinction because, full disclosure, this topic has a significant amount of depth that obviously is going to be a field of study in itself. An economist and anybody watching this video that has a significant amount of sophistication will have many comments to our comments. But in general, the idea that we're actually trying to convey is the fact that banks have the ability to create velocity of money by receiving deposits, creating loans. A lot of times those loans are multiples of what they receive in deposits.
Right.
That's what we call fractional banking, okay? So they can lend maybe 9 times, 10 times, whatever they have in deposits based on how their regulators are regulating their deposit rate or their reserve rate. And that whole system is sitting on top of another second layer of fractional reserve banking, which is the bank of last resort, the Fed, can backstop the banks by providing them reserves. That money never leaves the Fed. That money is money that the banks have in reserve at their savings account at the Fed. But because it becomes also reserves, additional capital that they can lend against, they can go and produce more and more loans in multiples. So the system is just laid out on top of a series of fractional systems that is just going to be frustrating to learn about because it gives you clarity on how much power banks have to control the money supply. And it begs the question again, why do we continue to give them more control and power in our lives by giving them more of our deposits when we should have a portion of those deposits under our control so we can benefit our families and businesses? So hopefully that's helpful as background. We're not going to get any more in detail on that. So we're going to go into the portion that matters the most to us, which is let's take a look at a couple of examples on how banks accomplish that velocity of money. So,
absolutely. Yeah, so this is a visual example of putting money with Bank of America. We're Bank of America, and this data is a little bit old, but had over $900 billion worth of deposits. On those deposits, only just over $3 billion was going back to people who had accounts with them, whereas those same people are getting billed about $50 billion in fees.
Yeah.
Late fees, whatever those fees are. So they're making more money on fees than we're making on interest deposits. And in this example, they're paying us on average 0.3%.
Yeah.
And their average loan at the time was about 5.5%. So what we're looking at here is 1,600% markup on what they're paying us versus what they're making, and none of that money is even theirs.
Yes, yes. And I was sharing an insight with you earlier today. Like, I used to teach this slide because I think it's important. It's important to recognize this is yet not velocity. This is just one version of how banks deploy their business. They control the capital, depositors put money in it, and because they control the capital, they have the ability to set terms on how that money is deposited, used, accessed, blah, blah, blah. These fees represent a significant portion of income for the bank just for being able to receive that money and protect it for the client. And the conclusion I used to drive in this slide was, well, if I look at the percentage they paid in deposit interest versus what they earn in fees alone, it's not the difference between these two numbers. It's not 4.2 or 4.16 or whatever it is. It's how much larger that return is compared to what they're paying depositors. That's a 16% rotation on that ability to collect fees versus the depositor interest. That is fascinating to me. How efficient are they at creating that type of return? Think about it. If you had $1,000 savings, if you make 1,600% returns that easily with not that much risk, would you want to do it? Of course.
Absolutely.
Of course. And that would be the end of what I would point out in the slides. But it occurred to me recently that what matters the most is not even that. What matters the most is, you know what, there's almost $1 trillion, $909 billion sitting under the control of the bank still. And this, to me, is the only part that matters. How much of your entire capital base is under your control at this point? Because that's what they've understood. The ability to do all this resides here. Where is money residing in your life? So that's one example of how easily the business of banking produces returns for banks. Let's talk a little more about, okay, what other ways now, other than fees, they have the ability to create velocity of money?
Right. So that would be the interest arbitrage.
Yeah.
So we give the bank $10,000. They're able to lend up to $100,000 off of that 10.
Yeah.
They're paying us, and this would be in a very, very high yield savings account of 4%. So
Right.
we'll use that.
We're being generous.
We're being very generous
Right.
because on a checking account, it's probably 0.1%.
Right.
So we give them that $10,000. I turn around and say, hey, I'd like to get a mortgage. They say, okay, we'll give it to you at 5%, for example. And all these rates aren't necessarily current. This is just for informational purposes. But in this markup, that's a 25% rate of return just on that. That 1% difference is 25% of that 4.
And, I love that you say that out of the bat because that's how you think now as a real estate investor. I love how it comes naturally to you. But I initially would have thought that this is a 1% difference. The bank is making 1%.
No, they're making 25% on that just 1% difference.
Yes.
So, that's with a house. If we look at cars, if we look at HELOCs or home improvement loans,
So
if we go get a credit card,
over and over,
they're marking up this money, making extreme rates of return on all of it.
So when we take the differentials between those interest rates, then we get to see the actual rotation of the money. They're going to do 1% over the 5 and 2% over the 6 and 3 and so on. And from the 18 is another 14. So total is 20% in differential.
In differential.
And most people would say, oh, they made 20%. Again, but as you pointed out so naturally earlier, the reality is that that is incorrect. I'm sorry, they made 16% because they paid 4 and they collected 20.
Right.
But the reality is that we need to compare how much larger is 20 as a proportion of 4, and that is 5 times or 500%.
500% rate of return.
And they're taking our money as savers and just deploying it back as loans to borrowers who happen to be the borrowers themselves, business owners and families in the United States. Fascinating concept, the banking process. And it's something that we need to start considering because we also look at it from the lens of like, okay, what properties am I going to buy? What cars am I going to buy? But are your kids going to need cars? Are your kids going to buy real estate? Are your kids going to finance things in life? Are your family, business owners, partners, your parents, your brothers, sisters? We are a potential source of capital, not just for our needs, but for others around us.
Right. If I could make that 4%, meanwhile lending out that money at 6%,
Yeah.
and make a 50% rate of return,
Yeah.
on that spread, that'd be fantastic.
In other words, the opportunity cost of having money sitting in a bank at 4%, which is incredibly generous, is that you could have also take that money and issue any of these loans and create that interest income for your family.
Correct.
But this is convenience. This requires financial education. This requires growth in your financial IQ. Absolutely. And we put the tip here because, hey, this is potentially an instrument for you to become that. And that is the premise of the infinite banking concept. We'll get more in depth as we go along in our conversations. But I wanted to throw that out there because, again, regardless of here, what should be here is the face of you and I or any one of the members of the audience thinking that we should be taking control of that function in our life. So the next question that we were going to talk about, and it's the question probably that matters the most at the end, is, okay, if we establish that banks are fantastic examples on how to generate money using money, right, through the velocity of money, through arbitrage, to staying in control of capital, and they do it so effectively every year, where do their savings, their profits go?
Right.
Are banks just spending everything they earn, or do they keep a portion of their capital somewhere?
Well, and this correlates to our last episode where we were talking about those 16 different items when looking at assets. The banks do the same thing, and they want all of those boxes checked.
Yeah.
And if Bank of America there has $900 billion and they need to keep some on the books in order to have that fractional reserve, where are they going to keep that fractional reserve that's still liquid, still generating a great rate of return, and everything else on that list? And ultimately, it's BOLI.
Yeah. So we're going to talk about that. What's BOLI? And that is a fascinating concept because it talks about something that's pretty important. What you see here at the bottom are current allocations from the most recent reports on the FDIC of how much cash value in whole life insurance, bank-owned life insurance, BOLI, is owned by the top largest banks in the United States. 24 billion, 19 billion, 12 billion, 5 billion. These are very recognized brands. I don't have to explain who these people are. But it begs the question, how come if these guys offer most of the financial products that families and business owners use in the economy, they go to a completely different asset class, a completely different industry, a completely different entity to put their savings in?
Right. Yeah, they're not necessarily just buying CDs like they tell us to do.
Exactly. They're not using their own savings products to store their capital with other banks. They're going to a separate entity in a different type of product in a contract to store their wealth.
Yeah, B of A is not going over to Wells asking them for a high yield savings account.
Yeah, it's probably not a good counterparty risk for them. Interestingly enough, it is for us supposedly. So why would they do that? And we don't, again, we're not in the business of saying right or wrong. We're not in the business of telling anyone what to do. We're finding information and communicating it because we think it's relevant. We think it's important for us to be aware. And we think it's critical for you to be able to make decisions about how you're managing your money, a portion of your money at a minimum, when it comes down to where your savings should reside and should we learn from the examples of success we have in the economy. So the idea of Tier 1 capital, I think, is really important. And most of us have heard that in the news, or that expression is a common expression, but I don't think it's really well understood. And a way to simplify that idea is banks talk about their pristine capital, the most clean, the most precious capital being stored as Tier 1. The regulators would say that that's their core capital to measure the strength of a bank and compare it to the risk they're taking and all the derivatives and loans and all the other stuff that represents risk. That Tier 1 capital is what compares to measure that the bank is well capitalized.
Right.
I'm going to say that again. To measure that the bank is well capitalized. That's going to become an important idea moving forward in the show.
And they need to be well capitalized so that when we go withdraw cash, it's actually there.
Yeah.
There's certain regulations so that a bank run doesn't occur, back in the early 1900s. So they have to have so much available in a secure area.
Yeah.
And they're looking for the highest rate of return on that in the most secure, liquid place possible.
Correct. I would even argue that, and we're going to see here the reasons why banks themselves say this is important, but I would say that they're only focusing on return of capital, not return on capital, because they have enough risk out there they can maximize. So,
Right.
an exercise, the second point I'm making here, an exercise that I like to share with clients, and we talk about a lot in Factum, is, think about this mental experiment. You walk into a bank, whatever bank locally you love, and you close your eyes and you try to imagine what's going to be in the lobby. And I make the joke, there's usually suckers on the entrance of the bank. But in reality, in the lobby, you'll find nice couches, beautiful office, and there's going to be probably a couple of alleys with brochures and product offerings. And one side, they're going to address the savers, and they're going to say, hey, we have checking accounts, savings accounts, CDs, all these portfolio products that you can use to save money, right? And that's how they address savers. Mm-hmm. On the other side of the alley, they're going to try to address the borrowers, and they're going to have a portfolio of products for debt. They're going to offer credit cards and mortgages and loans, in auto loans, personal loans, all the way you can access capital if you haven't saved to become a borrower. And the question that comes out of that is, in that mental exercise, do you ever imagine, or even in your real life, do you ever see the manager of the bank coming out and saying, would you like to do what we do with our savings? Would you like to use the same place that the banks use to put their capital, their pristine capital, so you can, play the role of the banker? It never happens. No. It will never happen. No. And it makes sense that it doesn't happen. Why would they take themselves out of the business of banking by teaching you what they know?
Right. If we are the biggest competitor to them, why would they teach us what they're doing?
It makes no sense. So it's not their obligation to do this. We have to educate ourselves. We have to understand that the role of banking, the role of that function as a process, not the institution itself, is very critical for their bottom line, and it should give you the thought that it probably would be very, very beneficial for you if you start recapturing that. So to close this conversation, I wanted to touch on a couple points. These are the things that banks themselves talk about, the benefits of using a different instrument for their savings. So they don't sell these financial assets. They need to go to the insurance companies to access this type of products. And they will say the following. They are trying to protect themselves against unexpected loss. That's pretty powerful. We talk about one of that guarantees and security as one of our ideal asset critical line items. Hold and grow cash reserve. Obviously, when we cannot lose or we cannot introduce risk into our savings, we would want to protect them and then have them grow as well.
Absolutely. Prepare
for an unpredictable future. Does that sound familiar for business owners or families? That seems quite important, to be well capitalized to prepare for unpredictable and uncertain future. Avoid taxes on gains and windfalls. Interesting. Very interesting. I'm going to leave it at that. How interesting is that? Keep pace with rising costs. So they're trying to use
inflation protection.
I don't think that's relevant or very timely at all right now, right? The last one, fund employee benefit programs. Banks really understand how this asset class works. And because they understand how it works, they use it to their benefit. They're controlling the banking function for most people in America, and they also understand that there are other products, other solutions for them to protect, grow, avoid taxes, avoid the effects of, or at least do something about the effects of inflation.
Right.
And then benefit their programs for employees in their institutions. They're very, very smart. So if they're doing this, maybe there's something there we should learn.
Absolutely. And something that's not on the list is they're protecting themselves from that, well, I guess it might be an unexpected loss, but it'd be the loss of a key person within that bank. So, their CEOs, their CFOs, COOs, every O out there is worth so much to that bank, so they want to protect themselves from that loss while still having liquid, safe, secure, growing capital that protects them also when we go ask for our cash back.
Yes, the return of capital, it's always there in their mind in terms of protection. So to wrap up today's show, I think we should recap really quick the ideas that we wanted to communicate. So if you listen to anything we've said today, it will be the following. I think that you should consider who around our society are good examples of capital management and also making money with money. Who is exemplifying in your life around you, whether it's a business, an institution, a wealthy person. For me, banks do not get more clear than that. who is exemplifying how velocity of money works and how they're able to build more money with their capital. I think that's a valuable lesson because it should show how we could probably do it at the you and me level. Number two is, hey, those examples of success, what do they do with their profits? What do they do with their capital? Are they using the same products that banks advertise to save their money? Or is there alternatives that I should continue that probably would help me protect, grow, all the things we've mentioned, my capital, my business capital, for me to have more prosperity and wealth in my community, in my business, in my family? Any parting words on your side?
It just goes back to emulate what you want to have happen. And the banks historically have been fantastic at becoming wealthier and wealthier and wealthier every year, mitigating their risk throughout the whole thing, and ultimately making obscene rates of return. So, if they are, and we've already showed, they're fantastic at making money. So they understand that, and when they have to choose to save so much of that because of their, metrics of how much they have to have on hand versus what they can lend, if they have to keep so much of that and they're picking this, why aren't we doing the same thing?
It has to be that we're unaware or misinformed, in my opinion. So the responsibility of every single one of us is to educate ourselves, at least consider it. You don't have to agree or disagree with any of the things we're saying. Again, our objective is to express our point of view and hopefully find one of you watching this show that finds that valuable and that adds more prosperity and growth for your financial life. So with that, I thought it was a great conversation. Thank you again for always entertaining these questions with me, and we'll see you in the next show.